Don't go anywhere. This is your retirement design differently with financial advisor Billy Voyles. He's the founder of Fundamental Wealth Designs. And I love hearing what's on his mind, how he can help you and Minnesota be and stay retired. I'm Spike Spangler. Billy Voyles, what's on your mind this week?
On my mind is the old to work or not to work, Spike, right? Do we want to continue working or do we want to retire?
Right, and we want to do a 2.0.
Yeah.
You actually, we did this wonderful program a couple of years ago, and we still get phone calls from it. We still get emails from it. People still scanning that QR code, but it's probably the biggest question. I think it's why it's so wildly popular. To work or not to work, how do you answer the question? And of course, we're playing a little bit off the great Baird, William Shakespeare. How do you start, and are there different factors we need to worry about for 2025?
Absolutely. I think it's kind of in your mind, and then it's in the money as well, right? Like in your mind, are you really still committed to the work? And then the money, like can you make it work where you can walk away and retire? And there's so many people out there that you have enough, you just don't know it yet because you don't have a plan.
Yeah, but where do you start, though, in determining that? Yeah, we can say that. Everybody out there is different, which you are. Every single one of our viewers out there, you are your own unique snowflake. But how do you know, how can you sit across from someone and say, I'm comfortable in telling you, you did a good job, you can retire? Because, I mean, if you get it wrong, they're not going to find out for 25 or 30 years.
Yeah, absolutely.
So what are maybe some of the factors that you do to help determine so you're comfortable in saying that?
Yeah. One of the biggest things is going back to the concept of spending, right? And going back to, there are, frugal individuals and there are those that spend a ton of money. So we really have to look at this concept of a target income in retirement. Like, what do you feel like you're going to need on a monthly basis after taxes for expenses? And this part's key. To live the life you want to live, though. To not have to feel like you're cutting back in retirement. To not have to feel like your lifestyle is going to change in retirement. And we want to get very specific on that, because if we're off by $1,000 in this monthly expenses, over retirement, that adds up. Over 25 to 30 years, that adds up to $1 million. Just $1,000 a month adds up to $1 million over a retirement. So that's where we have to start.
Figuring out to work or not to work, one of the biggest questions. And I think if we really boil it down, it's, am I going to run out of money in retirement?
Absolutely.
Are we going to run out of money in retirement? Some of the factors today have changed, or at least they're different. Interest rates, market volatility, tax situation, Social Security. Which one of these do you want to take on first? Which is a bigger concern for you today in 2025? Saying, can you work? Can you stop working? Market volatility? Where are we going with it? Where's your crystal ball, Billy?
Yeah.
What's going to happen this year?
Well, I think it's been no surprise that the market has been very volatile, in 2025. And that creates concern if you don't have your assets allocated appropriately for a retirement plan, right? If you have all your eggs in one basket, if you will, then market volatility is really going to impact you. The other thing, I had a client the other day, and they were sort of shocked because they've saved so much money that their fluctuations in their retirement accounts are now drastic. So they had $2 million, which is a ton of money. But looking back earlier this year when the tariffs and everything else were going on and you had extreme volatility and they were down like 18%, this was on their own. This was not, in their portfolios. They weren't with us yet. But they had lost $360,000 because, 18% on $100,000 is $18,000, right? It stinks, but it doesn't hurt that bad.
It'd be like driving back to your neighborhood one day and the house is gone.
Yeah.
That's a house worth $360,000.
Yes. So the larger your balances are, the more impactful this market volatility sort of becomes. But at the same time, the more opportunity. You make 10% on $2 million, you just made $200,000. So you don't want to dial it all the way back and not take any risk for the reward that you could achieve too at the same time. So it kind of gets tricky. But it is this whole, should I work or should I not? I know there's so many people out there wondering, I would really like to walk away, but I just don't know how, don't know where to start, don't know if I can, because it is one of the biggest fears, and you see different challenging number one fears in America. It's either public speaking or it's running out of money, right, before you pass. So
yeah, and the factors that go into it, I mean, I'm so glad that you kind of brought it down to numbers. Today, if you look at your retirement accounts and you see it go down, like if you hear on the news, oh, the Dow Jones or the S&P 500, went down by 1% or 2%, but when you put real dollars to it, it gives people a sense of, oh, wait a second, maybe I'm out over my skis. Maybe I'm taking too much risk. On the other hand, is there a concern of overcorrecting? So like, I mean, when we get to retirement, because your retirement is designed differently, is it taking all risk off the table, Billy?
Absolutely not, because again, we want to have risk in the right places that we talk about. And you're not going to spend all $2 million at once. So it's okay to take certain risk with certain assets, and it tends to be the assets that we want to also, be tax-free, if you will. So if you do have Roth accounts, that's going to be where we probably take the most risk, because those accounts are likely to be touched last, just in our structure. We see it all the time that people just don't have their distribution structured appropriately as well. You have taxable accounts, you have tax-deferred accounts, you have tax-free accounts. Which one of these should you tap first, and why, and how? All of these are great questions, right? And it depends on when you retire, right? If you're retiring, like some of our clients retire at 55 years old, because that's when they want to get out, and they can. Some people don't know how to bridge the gap to cover healthcare, though. That becomes the biggest sort of concern in this concept of retiring early. So if you have questions on how do I bridge this healthcare gap, that's also something we can help you with. And it's usually the one thing that's in the way of people retiring, and they have way more than they're going to need to cover that healthcare gap and retire the way they like, but it is this big cloud hanging over their head, and they just are uncertain on it. Can they make it happen?
An article that I pulled from the Retirement Research Institute says Americans are retiring 2 to 4 years later than they used to. And some of that might just be the question marks, not knowing, have you saved enough? How long do I need to make the money last? How is inflation and taxes going to impact it 20, 25 years down the road? Please explain exactly what the retirement design is. Do you help take away some of those question marks?
Absolutely. When we build a retirement design differently for you, we address all these different areas. And my biggest concerns as an advisor right now, are taxes and inflation. So I need to build a plan for you that helps withstand future tax increases by attacking the taxes today while they're low. I need to build a plan that's going to withstand inflation for you by using these great products that we have out there that can give you increasing income on a depreciating asset. And then we're also going to structure your risk appropriately so we have risk in the right places and we can earn terrific rates of returns when the markets are cooperating, right? And all of these things have to be built correctly inside a plan, but we need to start with that plan. We need to start with taking that first step. And all that first step is for you all out there today is just picking up that phone. And I know you all have your cell phones very close to you. Unfortunately, that's the world we live in today. It's sitting right next to you, you're in your hand, and you're scrolling Google, maybe checking out our website, seeing if we're real in the Twin Cities. We got 3 offices in the Twin Cities areas, one in North Oaks, one in Stillwater, one down in Mendota Heights. So pick up the phone and give us a call at 888-379-1846. Our team is standing by, has our calendars open. We have multiple advisors throughout these offices to sit with you and find out if we can help you and how much we can save you on your taxes and how much we can help you spend in retirement with your income plan.
Can't say it any better than that. Call that phone number right now. You can also scan the QR code if you like to. As Billy says, we all know your phones are right there. Open it up to the camera function and point it at the QR code and then just click on it. You can schedule your own appointment right there. More with Retirement Designed Differently and financial advisor Billy Voyles right after this.
We've coined the term retirement designed differently. People might ask why and how are you actually different? Well, 1, we are independent, take a fiduciary approach, and 3, we take a completely holistic approach at the same time. Having those three things at our disposal allows us to build exactly the type of plans we want. And we do so by following a very sort of specific guidelines in doing so. So the first is we want to create a foundational income plan for you. You have to know where your money is going to be coming from in order to spend it. Second is minimizing taxes, because we want to pay the least amount of tax legally possible over the rest of your life. Third is we want to make sure that we maximize sort of that risk-reward relationship. We find a lot of people coming in, they're paying excess fees, they're taking too much risk for what they're actually getting in return. And then last, let's have some fun. Because otherwise, what are we retiring for, right? We still have to have that goal, that why of retirement.
Welcome back. This is Retirement Designed Differently with financial advisor Billy Voyles. He is the founder of Fundamental Wealth Designs right here in Minnesota. As you just said, several offices all around the place. 3 different offices right now, several advisors as well helping you out. You get the same kind of retirement design no matter which one of our financial advisors you work with, all led by financial advisor Billy Voyles here. To work or not to work? I just said how the Retirement Research Institute says that Americans are retiring a good 2 to 4 years later than previous generations. Do you think this is from a lack of pension plans? Do you think this is for reasons of inflation and worrying about outrunning our money? Or are we more concerned about those healthcare costs later in life, or maybe a combination of all?
It's certainly a combination of all three, but healthcare costs are one of the things that we run into where people are concerned in 2 ways, and we mentioned this in the first segment. You have the concerns over paying for insurance before you hit Medicare, right? Concerns around that 58, 60, I got a 5 or 7 year gap where I'm going to have to pay for health insurance. What might that look like? And in Minnesota specifically, we actually have some interesting health structures in paying for private insurance through MNsure, and you can actually earn credits. So there is some advantage actually to being in Minnesota and being able to basically look like you appear, income poor, if you will, and living off cash investments during that time frame. And you can actually get some major credits from health insurance from MNsure, $12,000 to $14,000 a year. We take advantage of that income structure for a lot of our clients if we can. So, but again, if you're working with an investment professional and all they're doing is managing your investments, they don't know that. They're not aware of that. They're not a retirement specialist, and they don't know that rule can be taken advantage of. Right, so that's one of the things.
You discuss it a lot, and where are you getting your financial advice? I know this: if I've got a tooth that's aching me, I'm not going to go down to my mechanic, and vice versa. If I'm hearing a thunk in my engine, I'm not going to go to my dentist. There are specific people who focus on things. Your investment advisors, it's great. Maybe they helped you get to where you're at. Maybe you've been doing it yourself inside your 401k. Maybe you have an insurance person who's helped protect your family, and now they're talking about income tools. But retirement design, it is very different. It's literally why you've called it the retirement design, because we've got to do this differently than generations before. We don't have the pension plans. Yeah. So we've got to make sure that money lasts, and to add on to it, some of these healthcare costs, just an average number around the country, $5,800 a month for long-term care, the average stay being about 3.5 years. Now, we're in Minnesota. These are average numbers. Haven't you seen higher numbers even than that in long-term care?
It's much, much, much higher in Minnesota. You're looking at $8,000, maybe $9,000 a month for an assisted living, and that's the back half. So you sort of have this front half, concern of how do I bridge this gap to Medicare, and then you have long-term care at the end, and people are very concerned with, do I have enough if I get into a situation to pay for long-term care? I ran into a couple, and he was diagnosed with Parkinson's. So they have heightened concerns over extended stays in long-term care facilities, right? Your Alzheimer's, your dementias, your Parkinson's, these can present situations where it might extend beyond that 3-year average. However, in structuring their retirement, we could still structure it all right where they could walk away. They didn't have to continue working, even with projected costs in the $10,000 a month range for an extended period of time. But you just have to be prepared for it. You have to structure it correctly. Because long-term care, though, there's a lot of new opportunities in long-term care. Now, unfortunately, with the Parkinson's diagnosis, some of the insurance aspects, right, limited underwriting ability for him. But others out there that are still healthy, there are fantastic solutions to be able to address long-term care. So if long-term care and health care are the reasons that you just are unsure about, and this happens all the time in the DIY space, right? Like, yeah, you understand stocks, you understand the stock market, but are you an expert at long-term care and medical, sort of insurance? That's not, you're going to be where you're an expert at, right? So we can help you not only in the investment area, not only in structuring the income, but if long-term care is a concern, and who is this a concern for most? People that have witnessed it. The rest of you, it's very hard for you to get into your mind that this could possibly happen to you. And a lot of people end up where they're going to take the self-funding route. And that's okay. But people that have witnessed it, they really want to have a specific plan or product in place that's going to address long-term care should it happen to them.
I completely agree with you. We've seen it in my family. I know you've seen it in your family. And no one else, again, in my entire family tree will need to be convinced to have a conversation about long-term care. And here's the thing, folks. We want to remain positive. We always want to be positive. There are tools. There are things that you can do. Imagine if you could just leverage and have a tool help you pay for half of it, maybe even up to 2/3 of it, for a period of time, helping you keep more of your own nest egg, not just for yourself, but preserving it for your spouse. So how exactly would a tool work, and what kind of space are we talking about here?
Yeah, and I'll say that, the couple clients, we'll say hi to Art. Hey, Art, how you doing? He knows that he watches the show, and he told me it's okay. So they took a step, and they had money in the bank, right? And it was earning 2 or 3% interest. And we were able to give them something, a couple $100,000, and it was leveraged up to a $600,000 bucket of long-term care for the both of them, for him and his spouse. So $600,000 now set aside. The $200,000 is earning a great fixed rate of interest, right? It fluctuates based on timing, so I can't promise you a certain rate, but this was north of 5%. Tax-deferred rate of interest. And then it's a leveraged amount of money to help spend for long-term care coverages. So that $100,000 each jumps up to $300,000 each, or $600,000 for the couple to pay for long-term care. It was just sitting in the bank. It was only earning them 2 or 3% interest that they were then paying taxes on. If they pass away, the kids get the lump sum of money. They get the whole $200,000 plus all the interest earned. So it's sort of, it tackles a bunch of different things. It's a safe, secure way to provide a leveraged asset in order to pay for future long-term care. And now it's out of sight, out of mind. They have an asset set aside. They don't worry about it anymore. And to be relieved of those sort of future concerns around long-term care and to know they have an asset set aside in order to take care of it, it was a huge just sort of aha moment for them.
Yeah, and knowing that these tools are out there, you can have a conversation with someone like Billy Voyles. There's no cost to you. We'll get you started on your own retirement design. We understand you wanting to have safety and liquidity for what you've already put together for your savings for retirement, but do you need to access every single dollar of it right away? Probably not. So maybe there are tools that you can put in place that can help you leverage your own savings that you've already been working on for 3 or 4 decades, that can help you pay for your long-term care costs later down the road, preserving more of your own wealth, not just for yourself, but for your spouse, possibly for your heirs. Call that phone number. Call it right now. Let's get you started on your own retirement design. Or you can scan this QR code if you want to. Open up your phone to the camera function. Just point it at this box and click on it. You can schedule your own appointment right there. To work or not to work, what are some of the other fundamentals that Billy can answer for you when we get back right after this?
Is your largest retirement savings account one that you haven't paid taxes on? Like millions of Americans, you've saved into a retirement account that deferred paying taxes until you take the money out years later. One method to save on future taxes is called the Roth conversion. And you could do that right now to save yourself from paying higher taxes in the future. We are currently living during the lowest tax rates of our lifetimes. Would it make sense to pay those taxes now instead of in the future when those tax rates could be higher? Call Fundamental Wealth Designs today to see if doing a Roth conversion from your 401k or IRA account makes sense. This analysis is complimentary for our viewers who are serious about retirement planning. So ask yourself, would you rather pay lower taxes now or higher taxes in the future? Call the phone number you see here to get started right now. Do you think you will spend more money on food or health care in retirement? Do you take your investments out of the stock market now that you're retired? If so, how much? Will your Social Security check be reduced in the future? How do you produce income from your nest egg to fight costs like taxes and inflation? At Fundamental Wealth Designs, we take the guesswork out of retirement planning by designing a written plan that accounts for all of your concerns. The bigger question, am I going to be okay in retirement? Find out the answers to your retirement questions by calling us today at Fundamental Wealth Designs for your retirement designed differently.
Welcome back to Retirement Designed Differently with financial advisor Billy Voyles. To work or not to work? That might be the biggest question that you have right now. And what are those nightmares that are keeping you up at night? Have you saved enough? Will you need to cover things like long-term care? How do you get more tax efficient? Do you need to put together estate planning to work or not to work? I think it boils down to, do you have enough? Have you saved enough? Billy, as we close out today's show, you might need a financial advisor if, what is it today?
Yeah, you may need a financial advisor if you want to retire, but you're just not sure where to start. And if that's the case, I think you actually do know where to start, and it's right here. Give us a call.
Exactly. So many different factors in going into determining, do you want to become a fund manager for your portfolio in retirement? Do you want to become your CPA? Do you want to become your own estate planning attorney? All of these different, do you want to become your own insurance agent? Yeah. And I guess your own social manager as well. You got to have a lifestyle.
Yeah.
You know, who's going to book all those tea times?
Yeah, right.
And all the boats at the lake, you know, to get the catch. Where do you rank these as far as importance? You know, is it most important to make sure you've got a portfolio management style going into retirement? When you're putting together the entire design, what's the starting point?
I think the starting point is income, and you really need to figure out, like, how do your assets turn around and project the income you're going to need in retirement? And, you know, that is a tricky part because, again, a lot of times we see people and we meet them after they've been working with an advisor or they've been retired for a few years, and they come to us looking for that second opinion. And we love second opinions. As a fiduciary, we have to tell you if you're on the right track, you're on the right track. If not, we're going to tell you, you know, what changes we would be making. But they're not spending it as much as they could if they wanted to, becomes a result. So starting with figuring out how much you can spend in retirement, but then guess what? That all lays back to taxes fold into that, right? Inflation folds into that because, you know, you're going to need that amount to increase over the next 10 or 20 years. Long-term care folds back into that, right? Estate planning and efficiency, you know, it all is interrelated, but income to us is one of the places to start.
And I think one of the biggest triggers, as I look again here at your book, to Roth or not to Roth, is that people don't want to take out of those tax-deferred accounts because they realize they have to spend and pay all the taxes that they're pulling out. So they say, well, I don't want to spend because I got to pay taxes.
Yeah.
Well, now you're limiting your lifestyle to what? Maybe what you're getting in Social Security, which, by the way, you're going to have to pay taxes on that, although Minnesota has done a great job on the state tax level. But do you bring in the Roth conversion even if somebody is on the precipice of retirement, or is this something we needed to do a long time ago?
Absolutely. You have to bring in the Roth conversion conversation in that scenario earlier, because what you're going to end up doing is you're going to end up building up this huge pre-tax balance, and then you're going to pass it to your kids. And your kids, in a lot of situations, they're in a higher tax bracket than you are. And they're going to have to liquidate that entire IRA in 10 years. and they're going to end up jumping 1-2 tax, but they can end up paying 40%. So say you have $1 million IRA and you leave it to your children because you don't spend it and you don't convert it. Your children could end up only inheriting $600,000 of that. They could lose $400,000 to taxes. So one of the concepts that we work on is actually creating a tax-free inheritance for the kids. And how we do that is by structuring proper Roth conversions. I talked about, I think I was on last week's show, we talked about the couple that was just living off their Social Security and leaving their $30,000 standard deduction on the table. We could do Roth conversions without even incurring tax. That's a no-brainer. Others get into the gray area of how much should we do, what's really the most efficient amount, and that becomes a conversation back and forth.
Right. And one of the good things is we have heard through the legislation that the tax cuts will possibly be extended through the next 3 or 4 years. So a good result of that, again, there's ups and downs to it. It could increase what our debt load is here in the country, but it gives us more time to do these Roth conversions. What you're talking about is, I think we'll also continue to keep some of the largest standardized deductions through the next 3 or 4 years. So we can do a little bit, you can do a lot. We probably don't suggest doing it all at once, because if you get that tax bill, I think that will be quite surprising all at one time. So to find out if doing a Roth conversion makes sense to you, do yourself a favor, call the phone number. When you do, you'll get a complimentary copy of Billy's book, the To Roth or Not to Roth. And you can also come in and sit down and have a conversation with any one of our financial advisors, including Billy, to find out how we do these strategies. Now, a question on this. Do you actually implement the strategies? How does the Roth conversion work with a retirement financial advisor like yourself? Do you say, these are the concepts, I'll go find a CPA, or can you help walk somebody down the hallway of how to do it?
Yeah, we do it all for you in our house. And one of the things that people question too is RMDs, tax withholdings, tax strategies. You get into qualified contributions. There's all these different areas, and we want to simplify it for you, which is, again, why we integrate the 5 most important areas of retirement. You got income, tax, investment, estate planning, and healthcare. Those are 5 areas of concern for retirees. Those are 5 areas that need a plan to address for retirees today. So if you're wanting to retire and you're answering the question, to work or not to work, and it is not to work, go ahead and pick up the phone and give us a call, 888-379-1846. Our team's standing by to help schedule that meeting with us, and we'll sit down and help you retire in 2025.
Billy Voyles, financial advisor, thank you so very much. It is the question today, to work or not to work. You might be asking yourself that. Your spouse might be asking yourself that, hitting you over there in the elbow. Do we need to keep working? Let's get you retired. Get your own design started right now. Call that phone number. Thanks for watching. We'll be back next week.